Curious as to whether or not some of the big winners of 2022 still have gas in the tank? Looking for some of the very best long-term investments in the entire market? Wondering which of my investments did the best in 2022 and how I feel about them today? Then you have to check out today's video.
He is a best-selling author.
30-year-old Jason Fieber has a plan.
This guy retired at only 33 years old.
I don't know if I know too many people that have accomplished something like that.
He's really kind of a guru when it comes to passive income.
Before I get into today's content, if you want exclusive access to my personal six-figure stock portfolio and alerts on any new investments I make, check out the Patreon link in the description below. 2022 was a terrible year for the broader market. The S&P 500 finished down nearly 20% on the year. That is one of the worst years of all time. However, there are a number of individual names that held up much better. In fact, my own portfolio, which I call the Fire Fund, actually finished up on the year. Now, I did put some capital to work and that was a tailwind, but most of the fund's outperformance was totally organic. How did that happen? Well, the fund is chock full of high quality dividend growth stocks. And as I've mentioned time and time again, high quality dividend growth stocks tend to outperform the market over the long run. This shouldn't be a surprise. Only great businesses can produce the reliable rising profits necessary to afford reliable rising dividends. And great businesses should perform better than average. Today, I want to share with you 5 of my best performing dividend growth stocks for 2022 and whether or not they look buyable today. Ready? Let's dig in. The first dividend growth stock I'm highlighting today is Archer-Daniels-Midland Co., stock ticker ADM. Archer-Daniels-Midland is a multinational food processing and commodities trading corporation. Archer-Daniels-Midland, commonly known as ADM, is a wonderful business that flies way under the radar. It's part of the backbone of the global food supply, and guess what? We've all got to eat. With food supply disruptions stemming from the war in Eastern Europe, ADM's critical nature has only become more critical. This has helped to propel the business and stock to higher heights than ever before. This stock shot up by about 37% in 2022. That market-crushing price action is before factoring in the dividends, which is another area in which ADM beats the market. Let's get into that. This is a vaunted dividend aristocrat. We're talking about 47 consecutive years of dividend increases, which is a remarkable track record. The 10-year dividend growth rate is 8.4%, and the stock's yield of 1.9% beats the market even after such an amazing year, causing the price to rise and yield to fall. However, the stock's 5-year average yield is 2.8%, so the current yield is not nearly as appealing as it usually is. That said, the payout ratio is only 19% based on trailing 12 months adjusted EPS. That's laughably low, so I can't imagine any future in which ADM doesn't continue to increase the dividend at an inflation-beating rate. Love this business, love this stock. Don't love this valuation. I bought ADM years ago when it was around $35 a share. I thought it was a great deal then. Here at right about $86 a share, I don't feel the same. Now, most metrics aren't indicating expensiveness. For example, the PE ratio is only 11.9, but it's all about the E in the PE ratio, as in how resilient is that number. This business has been on fire, but the last 2 years have been outliers when you look at the long-term earnings history. Before buying, I'd wait for either a significant pullback in the stock pricing or further confirmation of a concretely higher earnings base. For now, I'm on the sidelines in terms of adding to my own position. On the other hand, I'm not selling ADM or any of the names I'm going over today. Like the great Peter Lynch said, selling your winners and holding your losers is like cutting the flowers and watering the weeds. The second dividend growth stock I want to go over today is Chevron Corporation, stock ticker CVX. Chevron is a multinational energy corporation. I've been a Chevron shareholder for many years, and to be totally honest, it hasn't been all sunshine. There were long stretches that were downright tough. parts of society were starting to sour on hydrocarbon companies a while back, which kind of left me scratching my head, but I never lost faith. After all, our modern day society doesn't work without reliable access to energy. And while I applaud humanity's moves into more sustainable forms of energy, as we have to think about the viability of our species thousands of years into the future, these other forms of energy simply aren't ready for prime time yet. Well, an energy crisis in Europe has caused a rude awakening. The world's been reminded of the importance of hydrocarbons, and Chevron's business has come roaring back, which has caused the stock to reawaken. Chevron's stock returned right about 51% in 2022, based on the price appreciation alone. Wow, and that's before the large dividend is factored in. This kind of extreme relative outperformance certainly makes up for some disappointing years in the past. Since Chevron is actually an overweight position for the fund, Chevron definitely helped with overall performance in 2022. But I'm not here to chase short-term outperformance. I'm here for safe, growing dividends that I can count on through thick and thin. Well, Chevron shines here. This is a dividend aristocrat with 35 consecutive years of dividend increases. The 10-year dividend growth rate of 5.1% pairs decently with the yield of 3.2%, although I'd prefer either a higher yield or higher dividend growth rate here. Nonetheless, the payout ratio is an extremely low 32.3% thanks to a great year for earnings. This dividend is headed higher. Despite the massive run-up, the stock still doesn't look expensive, but I'd be cautious here. Most of the multiples are either at or below the respective recent historical averages. The price-to-earnings ratio is only 10. The price-to-cash flow ratio of 7.4 compares favorably to its own 5-year average of 9.7. However, Chevron had a banner year in 2022. Their recent Q3 report for fiscal year 2022 showed $5.78 in earnings per share. That's more than the business did in the entire year of 2019. We did put out favorable coverage of Chevron multiple times over the last year or so, highlighting the appeal of the business. We even discussed how Warren Buffett had been loading up on this name. Personally, I'm a bit less enthusiastic at these higher levels, but due to imbalances between supply and demand, geopolitics, and a warmer societal attitude toward the business model, Chevron finally has some tailwinds at its back. The balance sheet has been cleaned up, and the profit picture looks better than it has in many years. I still like Chevron very much, but a 10% or so drop would make me like it even more. The third dividend growth stock that has to be highlighted is Lockheed Martin Corp, stock ticker LMT. Lockheed Martin is the world's largest defense contractor. Lockheed Martin was one of my top 5 stock ideas for 2022. It's also a large position for the fund. What can I say? I like to put my money where my mouth is. In the case of Lockheed Martin, I put my money to work with one of the best companies on the planet. This company practically prints money because its largest customer, the US government, literally prints money. With geopolitics heating up in a big way recently, that can only mean more demand for Lockheed Martin's products and services. And that's why there's been more demand for Lockheed Martin's shares. This stock rose by approximately 37% in 2022. You're basically looking at a 40% one-year return after factoring in the dividend. That'd be incredible in any year, but it's especially incredible in a year in which the S&P 500 dropped by almost 20%. But a long-term dividend growth investor like myself sees capital gain like this as a byproduct of investing in great businesses. The focus, however, is always on that safe, growing dividend income that one can live off of. In this regard, Lockheed Martin is a lock. The company has increased its dividend for 20 consecutive years with a 10-year dividend growth rate of 10.9%. The stock offers a compelling 2.6% yield to start off with, and the payout ratio of 55.7% based on earnings per share guidance for fiscal year 2022 shows what a long growth runway the dividend still has. The stock had a great 2022, but I see no reason why it won't have a great 2023, 2024, 2025, etc. The business is currently going for almost $460 per share. Would a buyer prefer $450 per share or $400 a share? Absolutely, we always want to pay less, but I think this is one of the best businesses a long-term dividend growth investor can get their hands on. And being too myopic about trying to get the absolute best deal today could leave you missing out on decades of growth. We analyzed and valued Lockheed Martin a few months ago, estimating the intrinsic value of the business at nearly $450 per share. I basically see the business as fairly valued right here, and you could do a lot worse than buy a wonderful business for a fair price. In my view, Lockheed Martin is buyable right here, right now. The fourth dividend growth stock I have to tell you about is Merck & Co. Inc., stock ticker MRK. Merck is a multinational pharmaceutical company. When you think of Merck, you should immediately think of Keytruda, the company's blockbuster cancer drug that brought in over $5 billion in sales for the most recent quarter and is poised to become the best-selling drug in the whole world. The success of Keytruda is the tide lifting the entire Merck boat, as the business and stock had a fantastic 2022. By the way, that's one of the underlying points throughout this whole video. If you want great stocks, you have to invest in great businesses. Stocks are slices of real businesses. If you invest in a terrible business, you're buying a terrible stock. Don't do that. And if you decide to do this anyway, don't complain when you perform poorly. Merck's shares jumped by about 44% in 2022. Market down 20%? No problem. A great business like Merck to the rescue. When you add in the dividend, you get to almost 50% on the year. Very impressive. Also impressive is the dividend, which is likely to go down as one of the best in all of Big Pharma when all is said and done. Merck has increased its dividend for 12 consecutive years with a 10-year dividend growth rate of 5.1%. The dividend raises have been a bit lumpy, but I see future dividend raises as being larger as a result of Keytruda's success. The stock also yields 2.5%, which isn't bad at all in this environment. The payout ratio, which is 48.6%, gives Merck plenty of leeway for future dividend raises. Look, Merck isn't a steal anymore, but I don't see the current valuation as egregious. Merck was another one of my top 5 stock ideas for 2022. That also turned out pretty well. Now, it's not the no-brainer investment that it was when we made that video, but it's also not necessarily something that I'd be outright avoiding in early 2023. The price-earnings ratio of 19.1 isn't unreasonable, especially when considering that Keytruda is just getting warmed up. I was buying Merck when Warren Buffett was selling it, and we put out videos where I openly disagreed with my hero, the Oracle of Omaha, on this one. Also, we highlighted this name as being undervalued as recently as March 2022. That last video showed why the estimate for Merck's fair value is right about $100 per share. Merck is currently selling for about $115 per share. If you need more exposure to Big Pharma in your portfolio, Merck is still worth considering, especially if you're in it for the next 10 plus years. But seeing as how a big discount has perhaps turned into a modest premium, a 10% correction from here would make Merck very interesting again. The fifth dividend growth stock we have to quickly discuss is Exxon Mobil Corp., stock ticker XOM. Exxon Mobil is a multinational oil and gas corporation. Not a surprise to see a second oil and gas supermajor on today's list alongside Chevron. Oil companies dominated 2022. Exxon Mobil's Q3 fiscal year 2022 quarterly report, their most recent, showed $112.1 billion in revenue. Many of the companies in the S&P 500 don't have annual sales at that level. That same report showed $4.68 in earnings per share, which beats the earnings per share that ExxonMobil recorded for the entirety of fiscal year 2019. When the business skyrockets like this, it shouldn't be a surprise to see its stock skyrocket, particularly when the stock had low expectations baked in from the start. This stock skyrocketed higher by about 74% in 2022. After you factor in the outsized dividend, ExxonMobil came in with a total return of almost 80% on the year. That is a jaw-dropping number, and it does make up for quite a few poor years leading up to 2022. What's helped longtime shareholders like myself to hold on through those tough years has been ExxonMobil's dividend. The stock has typically offered a high yield, and it's a dividend that shareholders have been able to count on no matter what happens with the price of oil. Indeed, ExxonMobil has raised its dividend for 40 consecutive years, easily qualifying it for its esteemed dividend aristocrat status. The 10-year dividend growth rate is 5.4%, not outstanding, but respectable. The 3.4% yield here is also respectable, and the payout ratio is 29.7%, which is about as low as I've ever seen it for ExxonMobil. A lot of the recent performance has been the result of a coiled spring viciously uncoiling, but it's not overdone. A lot of what I said about Chevron can also be applied here, but ExxonMobil does look cheaper right across the board. Indeed, this stock right now is basically priced the same as it was back in late 2007, 15 years ago. ExxonMobil's business kept plodding along, the stock went nowhere, earnings moved way up recently, and the spring, it just couldn't coil any longer. Pretty much every multiple here is lower than Chevron's respective comparison, and they all indicate that Exxon Mobil still looks cheap. Its price-earnings ratio is only 8.8, for instance. However, it really does come down to the longevity and durability of recent results. It is, after all, a cyclical industry. As with Chevron, I do think the paradigm for Exxon Mobil has shifted in a positive way, and that bodes well. But there's been some greed around this name, which makes me a bit fearful. The stock is currently priced at about $108. Personally, I become enthusiastic again below the $100 mark. Thanks so much for watching. I hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about these 5 big dividend growth stock winners for 2022. Please make sure to subscribe to the channel and ring that notification bell so you don't miss out on new content. Also take a look at the description box below for some important links, including a link to my personal stock portfolio. This 6-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It'll allow me to retire in my early 30s. I've made my portfolio entirely accessible over at Patreon, and I also post alerts there whenever I buy or sell a stock. I put my money where my mouth is, and I'm often invested in the same high quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who've been profiting from many of the same exact stocks that I own. So if you think this is something that you could benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.